This is Viewpoints by Hennessy, a podcast featuring the latest thinking from the team at Hennessy Funds. My name is Jay Coulter, and joining me for this update is portfolio manager Dave Ellison. Dave manages both the Hennessy Large Cap Financial Fund and the Hennessy Small Cap Financial Fund. Let's jump right in. Dave, in 2024, it was a phenomenal year for the financial sector, delivering around 30% returns. From your perspective, what were the main drivers of this performance?
Well, good afternoon. I think generally it was a change in sort of the macro environment. Rates went from going up to not going up to going down a little bit. The yield curve went from being, pretty inverted to less inverted. Loan demand was a little better. Regulatory climate was a little better. And we've had, down earnings for 2 or 3 years now. And this will be the first year of up earnings in 3 or 4 years. So I think all of those sort of combine to take the sort of the downside pressure off the group.
So, Dave, the Fed's approach to rate cuts this year will undoubtedly play a really pivotal role in the financial sector. How do you see these cuts impacting the different financial subsectors?
Well, I don't think rates moving one way or the other matter as much as what the term structure of rates are, meaning the yield curve. So to me, it's more like what is the yield curve going to look like a year from now, not what the absolute level of rates are going to be. And that's a little more unpredictable, but I think generally the where rates are now, most of the subsectors are getting better. They've gone through a major mark-to-market problem on as rates rose. They're dealing with credit, so there really isn't any big advantage to one subsector or the other. This is an industry that's fairly homogeneous, and they all benefit together. And I think that's sort of why the indexes all were up. There wasn't any really big outperformers or big underperformers within the subsectors of the group.
As a follow up, do you have any thoughts on what the curve might look like at the end of the year?
Well, it's hard to, tell with the new administration. I think they're doing a lot of things that could move things one way or the other. I do think the Fed has been very good at basically telling you what they're going to do, what they're looking at, and what their sort of sense is in terms of what rates are going to do. So I think as long as they stay predictable and understandable, I think the market will be okay with that. And I think, where we are now is a pretty good place in terms of where rates are. So I'm not too concerned about sort of what the fiscal policy is going to be. The question is, what is the fiscal policy going to do, and how's that going to change, and how's that going to disrupt things? Maybe it makes it better, but that's why we come to work every day.
That's right. That's right. Let's talk about net interest margin. With rate cuts potentially impacting NIM, what are banks doing to boost non interest income?
Well, that's been a big issue for the industry, especially with the smaller banks. They've lost sort of non-interest income because pricing has gone down on things like service fees, bounce checks, interchange fees with the credit card companies, and other related sort of commercial fees that they charge their customers. So that's been a real problem. The bigger banks have been able to manage that with just having larger customers and a lot of Wall Street sort of income, as I call it. So, and along with little asset management as well. So I think that's a struggle for the industry. And that's sort of one of the things that's sort of driving, I think will continue to drive consolidation. You need to get bigger to have these other services. And I think that's a theme for, in my view, for the next, the many years ahead.
So, Dave, with the new administration, there's speculation about possible regulatory changes. What might these changes look like, and how could they impact the large cap side of the financial services sector versus the small cap?
Well, I think that, it's hard to know what they're actually going to target, in terms of wanting to change and whether they can change it or not. I think to me, the biggest and easiest thing to do is to just allow more acquisition activity. And I think that will benefit the smaller banks because that's a real sort of value add there when it comes to the smaller space. The acquisition process has really added to performance of the fund over many years. The large banks, it's really a function of whether they lighten up on the liquidity requirements and allow them to enter other businesses. I think part of the problem with the industry is that they haven't been able to add new products, innovate, and or grow, and it's all happened around them. And I think if they allow transformative acquisitions within the large cap industry, that will be a catalyst for a lot of change and a lot of opportunity for the investors.
Yeah. So, Dave, high rates have really created challenges for some borrowers in the marketplace, particularly around mortgages. How do you see this affecting loan growth this year?
Well, loan growth's been a problem for years, surprisingly, and there's been a big shift in my view, away from borrowing at banks and borrowing at private equity, private debt, and other sources of capital that are out there. And I think that's something that the regulatory structure can change, and we'll see what happens there. But I do think loans are, that's the lifeblood of a bank. You throw in some deposits and you make a decent living. And the problem is that besides having no new products and no innovation, they haven't had a lot of the sort of the bread and butter of the industry. They've been struggling to keep market share, and that's an industry problem.
Yeah, just as a follow-up, Dave, do you see any thawing in the mortgage marketplace and the housing marketplace in the next 12, 18 months?
Well, I could talk for an hour about that. I think the 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 struggle here is that there isn't enough housing. We all sort of know that. We understand the math of what's happened the last 10 or 15 years with the housing starts versus population growth. Uh, there isn't a corporate incentive or a tax incentive to add to housing, like there is, let's say, in the CHIPS Act or something like that. They're giving money to build chip factories, but what about giving money to help build the housing that the people are going to supposedly live in, right? So that's a bigger issue. But I think the struggle is home prices are up. I don't see them going down, and it's creating intergenerational problems with with affordability. I don't know how that ends, but again, most of the people that vote own houses, and they're not going to want them to go down in price in a big way. And I don't see where the government's going to in any way do that. So I think the struggle continues, and it's going to go on for a while.
So AI has been a hot topic for the past year, maybe longer. How has it enhanced the overall operational efficiency in the financial sector? And are there any areas where there's potentially some untapped growth that could be found?
Well, so far we don't see much. There's a lot of investment going on, especially with the bigger banks because they have the money to do it. Um, and so far we haven't heard like, oh my God, I found a new way to balance a checkbook, and so it's a lot cheaper or something like that, or make a loan or something like that. But I think the initial thing is they'll be able to maybe streamline expenses, but stocks don't go up a lot because you're cutting expenses. They go up a lot because you're generating revenue at a good margin. And so the question still is going to come down to loan demand, margins, ability to drive other non-fee income sources. And so I think that, so far AI it's there, we'll see. And again, that's why we come to work every day and try to figure that out.
Within your large cap and small cap financial funds, which subsectors look the most attractive here at the start of 2025?
Well, I think the on the big side or the big bank, big financial services side, um, I think all of those guys, they have, somewhat of a monopolistic position. They have the network effect. They have the product services they need to retain customers, both at the commercial side and the consumer side. So I think they're going to be okay. And I think you could argue that we have FANG in tech, and we're going to have some sort of FANG in financials, especially with the big guys. because they're just making so much money and investing so much more than the guys below them that they're just going to get ahead. The smaller banks, they need to consolidate. The value add there is 1 plus 1 is a little more than 2, and you can add value to the shareholders by doing that, either by cutting costs or entering markets and being more efficient in certain markets. So the I think the big guys have the benefit of size and profitability, and the little guys have the ability to consolidate. So both places you can make money, and that's hopefully what I'm trying to do with the portfolios.
Excellent. Dave, our last question. As you look ahead to through 2025, what are some of the key themes and maybe the risks that you're keeping your eyes on?
Well, I think the risks are always about credit and about what rates do. And obviously, we've gone through a cycle just recently, a couple of winters ago, where we had rates go up and people started to get in trouble and the stocks all went down. We've had concerns about credit, especially with office, and that's been out there for a couple of years now. Everybody's still worried about it. So the risks are sort of the traditional risks in banking: liquidity, capital, credit, the typical stuff. I think in terms of the bigger sort of transformative risks, or how are they going to compete, and how are they going to continue to compete in this environment where capital's getting easier to come by, and the technology is changing how people want to use their capital and deploy their capital. Websites are getting faster and easier, and then you've got the whole issue with crypto and encryption and security and all those other things. So I think there's traditional risks, and then there's the new risks, and obviously that's in a sense why the bigger companies have an advantage, because they can invest in trying to tamp down those risks and understand what they are. And so I think the risks are existential almost, and the traditional risks are still there, but they're manageable and understandable.
Well, Dave, thank you for your time today. Viewers, to learn more about Hennessy Funds, please visit hennessyfunds.com.